Even more bad news surrounding the Fed, and they are upside down on inflation, and that's a big risk. Economists say it's hard to understand how the Fed will bring inflation down if the federal funds rate remains negative throughout the year, and as shown in officials' own projections. The last time the U.S. suffered a nasty bout of inflation in the 1980s, the economic emergency was seen as so dire, the Federal Reserve, then led by Paul Volcker, jacked up interest rates by as much as 3 percentage points. That's about 6 times the pace seen in a more typical rate hiking cycle, where the Fed moves in 0.25 percentage point increments. Quote, unless we respond to the increase, which could be quite large in this period, we're going to have a real credibility problem, end quote. Donald Wynn, former senior official of the Federal Reserve Board, told Volcker at the Fed meeting in March of 1980, according to the meeting transcript. Eventually, the U.S. central bank's main interest rate was some 5 percentage points over the inflation rate. The increase induced a sharp recession, but the intent worked. Inflation soon subsided. Now, there's a similar gap between inflation and the federal funds rate, but the relationship is upside down. Inflation surged to a fresh 4-decade high of 9.1% last month, and the Fed officials are worried, although several governors of the U.S. central bank have talked down the prospect of a 1 percentage point rate hike, expressing their preference for a 0.75% percentage point hike. Such a move would raise the federal funds rate to a range between 2.25% and 2.5%, which would still be at least 6 percentage points below the current headline inflation rate. Last month, Fed officials published their fresh quarterly economic projections, or dot plot, and members of the rate-setting Federal Open Market Committee expected the federal funds rate to be at 3.4%, while inflation is forecasted to be at 5.2% by the end of the year. The point is, Fed officials aren't moving with anything close to the urgency seen in the Volcker era. That's a risk, some top economists say. We're as close to an inflation emergency as we've been any time in the past 40 years, said Michael Feroli, chief U.S. economist at JP Morgan. The only thing that's keeping it from being a full-blown, no-holds-barred emergency is that longer-term inflation expectations still seem reasonably well anchored. The dynamic is being closely watched in the Bitcoin market, partly because the price performance of the largest cryptocurrency by market capitalization has recently been correlated with U.S. stocks. Now, that's where things get confusing, like I was talking about earlier, because the halving cycle would determine that we would see this happen regardless of the actual stock market and their price. But because of the timing of both of them taking place, we have this kind of appearance that it is following it. I don't know which one's true. I'd like to hear from you guys. Do you guys think this is part of the traditional halving cycle of Bitcoin and it still has this kind of, I guess, potential promise to be a hedge against inflation? Or do you think it is following the stock market and it will follow the rest of the asset classes? Faster interest rate hikes will make bonds more attractive to investors. Higher borrowing costs will eat into corporate earnings and slow the pace of investment, which could affect stock prices. The Bitcoin price is down about 49% this year, currently around $23,351. Actually, right now, as we speak, it's at $24,089 US. Dan Moorhead, CEO of Pantera Capital, recently wrote that the difference between inflation and the federal funds rate is larger than at any point in history. The rate currently sits where it was before the coronavirus pandemic, when inflation was at 2.3%. On Friday, a University of Michigan survey showed that consumers see inflation running at 2.8% over a 5-year horizon, down from an expected 3.1% in June. However, current inflation is still running at a 4-decade high, and Fed Chair Jerome Powell has admitted that the U.S. central bank underestimated the pace of consumer price rises and was wrong about calling it transitory. Oh, they're finally admitting that. Woohoo. He also repeatedly said the economy, thanks to very hot labor market, is very strong, which is why many market participants predicted a 100 basis point, 1 percentage point hike in July. The Fed's current target is to get the federal funds rate to a longer run neutral rate of 2.5%. But minutes of the last FOMC meeting show that officials plan for the rate increases that would take the ratio to 3.4% this year. I think there's a good reason for 100 to or 125 basis points, but I think one of the strongest reasons for 75 basis points is that 275 basis points hike gets you neutral, and then you can start calibrating from there, Feroli said. But these measured calculations are a far cry from the swift emergency action the Federal Reserve took to slash rates during the market crash of March 2020 because of the pandemic's expected economic impact, or during the financial crisis of 2008. Vincent Reinhart, a former Fed official who's now chief economist and macro strategist at BNY Mellon, says that it's hard to understand how the Fed will bring inflation down if the federal funds rate remains negative throughout the year, as shown in officials' own projections. Reinhart noted that the Fed risks violating the Taylor principle. According to the Taylor principle, the real interest rate should be raised more than 1-for-1 when inflation increases, but the rate is currently negative because it is lower than inflation. That's a complaint you can have about the Federal Reserve right now, Reinhart said. Another risk of the Fed's light approach could be the fear of losing credibility. The Fed's use, I thought they already lost it. I'm sorry. The Fed's use of the forward guidance to prepare and control markets for coming rate hikes and innovation of recent decades only works as long as investors believe that the officials will follow through. Powell really hates surprising markets, Reinhart said. He wants to control the narrative, and he wants to make sure there's no surprise. Last month, Fed officials changed their minds about the level of rate increase at the last minute after a higher than expected inflation period. This time, they may stick to their initial plan. Fed officials at the end of May signaled that they would likely raise interest rates by 75 basis points in July, given that inflation was expected to accelerate slightly in June. But even though the CPI came in much stronger than forecast, the Fed stuck with its plan. I think they probably got some blowback from what appeared to be a bit of choppiness in the last meeting, JP Morgan's Feroli said on the Fed. It didn't appear that there was a steady advance, and I think to go from 75 to 100 basis points may appear choppier, more unstable perhaps. Consistently making decisions before the FOMC meetings even take place also undercuts the importance of the two-day closed-door discussions. The FOMC wants to do multiple things, and they are not all mutually consistent, said BNY Mellon's Reinhart. You want guidance. You want to convey that you're going to be doing with rates to investors, or what you're going to be doing with rates to investors, so that they can price it in advance. On the other hand, you also want to be responsive to incoming information. If you give guidance that is not described by the incoming information, what do you do? If you can change the plan between meetings, are you respecting the consultations of the committee, he said. If all goes according to the Fed's plan, inflation will decelerate, notably in the fourth quarter, according to Feroli. And if the officials' projections prove accurate, the federal funds rate will be as high as 3.5% by the year end. So at least in quarterly sequential annualized terms, you will get back to a positive real Fed funds rate by the fourth quarter, if not sooner, he said. That's a gradual return to normal. It assumes emergency actions aren't needed. And I think this is interesting because if you look at it the way it was handled previously, you would expect that you would see it be in an emergency situation now, and you would want to raise those hikes up, much more, maybe 3%, something like that, like it was done before, to resolve it. But it seems to be kind of at a position where they don't want to freak the markets out. Does that end up affecting cryptocurrency? I mean, I think it will affect it. The question is, how will it affect it? Will it affect it positively or negatively, right? Will runaway inflation, if that was something that was going to happen, affect Bitcoin price to go up? And I think in general, you would expect it to, if we were expecting it to do what it's kind of set out to do in the first place. I don't know for sure. Like I said, when I originally looked at like the halving cycle, I expected Bitcoin to be where it's at or in this range for the bear market in the crypto winter, regardless of what was going on in the macroeconomics. But the timing of it with what everything else that is going on in macroeconomics makes it kind of confusing to, say with certainty. So I'll definitely have to lean on y'all in chat and comment section and stuff to get some ideas on what we all think. Thanks for checking out this clip from the Crypto Mining Show. You can check out the full episode here or more crypto content down here. Also, I'd like you to check out my locals page at sonofatech.locals.com, where you can become a member for free or choose to be a $5 a month supporter that unlocks additional content.